Hello everyone, welcome to BISP Solutions. BISP Solutions is a tech company that provides technical solutions across the world. So today we will be having our webinar on financial modeling. So in our previous sessions we understood about why we are learning financial modeling and what is the importance of financial modeling in our business or companies like that. So today we will be learning about the advance of financial modeling. So in our previous session what we have covered is what financial modeling is about and why we study financial modeling, what are the steps involved in creating financial modeling, and what setups we need to do while doing financial modelings. So let's do a reiteration of those topics. First was our meaning of financial modeling, which is the process of creating a summary of a company's expenses and earnings in the form of a spreadsheet that can be used to calculate the impact of a future event or decision. It means, like, imagine if we are running a small business like a bakery, so we should know how much profit we will be making next year, and can we afford to open a second outlet of the same bakery, and will we have enough money to pay salaries every month. So a financial modeling is a calculator built in Excel that answers these questions by combining your income, expenses, plans, and assumptions about the future, like sales growth, rent, cost of materials, etc. So it's just a way to predict the future of a business using numbers only. So why financial modeling is important? It provides us better decision making, funding and investment of investors, and identifying future risk, and planning cash flow and loan repayment planning is done by preparing financial modeling. So steps involved in financial modeling: first step is to understand the business, which means we should know what the business does and how it earns and spends and its goals. So for example, if we are modeling a coffee shop, we should understand how many coffee are sold per day, what rent and salary cost is there, etc. Next step is our gathering historical data, where we will be collecting the past 2 to 3 years of data of revenue, cost, profits and cash flows. Like, if we are having a coffee shop and our coffee shop made 10 lakh rupees in 2022 and 12 lakh rupees in 2023, and we have spent rupees 7 lakh in 2023, so we will be using this pattern to identify what is the revenue and what is the expenditure. Next is our making assumptions, where we will be predicting future growth using logical guesses like sales will grow by 10% yearly, rent will increase by 5% next year. So for example, if we are selling 1000 coffees per month this year, so we will be assuming 1100 next year. Step 4 is building the model in Excel, where we will be making separate sheets for our revenue, cost, cash flow, balance sheets and assumption sheet. So for that we will be using formulas like revenue minus cost for profit, PMT to calculate loan prepayments, and IF, which is if, to add flexibility. So if we are adding cost of coffee beans as 5 rupees per cup, so we will be multiplying by number of cups sold. Next is our scenario and sensitivity analysis, where we will be checking different situations, like best case where sales is increasing by 20%, worst case where sales is dropped by 30%, and what if salary cost rises. So we will be making 3 versions of our coffee shop model, where one where sales are high, another one where they stay flat, and one they will be falling. Step 6 is to create final output or reports, where we will be summarizing all the data: income statement, cash flow statement, key metrics, profit, ROI and break even. where we will be adding charts for better visuals. So making a graph showing monthly profits and a table comparing expenses versus income is included in our final output or reports. So what do we get from a financial modeling? Future projections of next 3 to 5 years, break-even analysis where when will we start making profits, and cash flow tracking where when will we run out of money, and dashboards and visual charts for presentations, and decision support tool for management or investors. So if we are preparing a financial model, so let's take a case study of having a coffee shop. So this is a case study of Ria where she wants to open a coffee shop. So she requires 10 lakh rupees. So equity share capital, she is investing 5 lakh rupees from her own savings, and she issues herself 50,000 shares which is of 10 rupees each, and also she had taken loan from bank of 10 lakh rupees. So now she uses this money to buy fixed assets where she will be purchasing furniture, coffee machine, kitchen equipment of 8 lakh rupees, and a capital work in progress where under construction terrace seating is there which will cost around 2 lakh rupees. Investments where she has invested in short term FD for emergency need if there is any. She had made FD of 1 lakh rupees. Inventory where raw materials like coffee, milk, bread is there, it is around 1 lakh rupees. And receivables where she has tied up with the corporate offices for bulk lunch delivery, so they owe her 50,000 rupees, and rest of the money left in her account was 2,50,000. So if we want to calculate our total assets, so fixed assets plus capital work in progress plus investments plus receivables plus inventory plus cash, that total will be 15 lakh. So first month her revenue, which is sales, was 4 lakh rupees, and COGS, which is raw materials and ingredients, was around 1,50,000. So she got a gross profit of 2,50,000. Then selling and general expenses where rent, staff, salaries and electricity bill is paid of 1 lakh rupees. So EBITDA, which is earnings before interest, tax, depreciation, is calculated as 1,50,000. Now depreciation on fixed assets which she has purchased is of 20,000. So if I want to calculate EBIT, which is opening profit, is around 1,30,000. Interest on loan is 30,000 which she has taken for 10 lakh rupees from bank. So if we want to calculate our EBT, which is of 1 lakh rupees, and after deducting tax, which is of 25,000, so she got net profit of 75,000. Now she has distributed profits and reserves. So dividend per share, she is giving dividend at 0.50 rupees per share. So it will be calculated as 25,000, where 50,000 shares was there, and 0.5 per share she is giving, so 25,000 is there. Then retained earnings, which is 50,000 rupees, which is calculated as 75,000 minus 25,000, she will be getting 50,000 rupees. So this retained earnings will be added to reserves in the balance sheet. After that, she has created balance sheet. So equity, she has given 5 lakh rupees from her savings, and reserves are 5 lakh rupees. sorry, 50,000, which is over here also. So this constitutes 5,50,000. Then comes our liabilities, which is borrowings. She has taken 10 lakh rupees from bank. Other liabilities, which is unpaid bills of 50,000. So total liabilities costing around 10,50,000. Next is assets, which is fixed assets, where 8 lakh rupees of fixed assets are there. CWIP, which is capital work in progress, is 2 lakh. Investments is 1 lakh, and receivables is 50,000. Inventory is 1 lakh, and cash in bank is 2,50,000. So it will be constituting as 15 lakh. After that, she has made cash flow statements, where operating activities is net profit 75,000, with where we will be adding depreciation of 20,000, and working capital changes, where we will be adding receivables plus inventory, which is around 1,50,000. So net cash from operating is 55,000. Investing activities, where she has spent on capital work, where the terrace is under construction of 2 lakh rupees. Investment in FD is 1 lakh. So cash outflow is 3 lakh rupees. Financing activities, loan taken from bank is 10 lakh, and capital invested from her savings is 5 lakh, and dividend she has paid to her shareholders, which is 25,000. So net cash flow is 14,75,000. So through this simple cafe story, we saw how each financial term is not just a number, but a reflection of real business activities. Financial modeling is about telling the story of a business in numbers, how much it earns, spends, grows, and saves. So, coming to our next topic, what we will be covering today is our simplification and making financial statement for a company. So, first of all, why simplification in FM is required. So simplification in financial modeling is important because it helps making the model easy to understand, use, and maintain. And a simple model clearly shows the relationship between inputs and outputs, making it easier for users to test assumptions and make decisions. And complex models can lead to confusion, errors, and wrong conclusions. And lastly, by focusing on key drivers and avoiding unnecessary details, simplification saves times and helps communicating results clearly to stakeholders who may not have a finance background. So let's take a small example where imagine we are running a small business like a coffee shop only. So we need to make smart decisions like how much to invest, what to sell, how to manage cost, and whether we are making a profit or not. So financial modeling is like building a roadmap with numbers. It helps us predicting the future, understanding risk, and making better decisions. So we will be clearly understanding it by Excel, simplification of financial modeling. So this is the simplification Excel sheet. So in this sheet we will be understanding formulas which we will be using in our financial statements, balance sheet, and all while preparing financial modeling. So first thing we have to understand is our simplification. So these simplification 1, 2, 3, these sheets likely break down basic components like revenue, cost, and profit. So thinking of our business like managing a kitchen, so we track what we earn, which is revenue, what we spend is cost, what is left is profit. So these are the ingredients of any financial story. Learning these basics helps you understand whether your business is healthy or struggling, just like reading a thermometer tells us if you have a fever or not. So this is our data where risk-free rate is 4%, market returns is 10%, beta is 1.25, cost of debt is 14%, tax rate is 30%, and equity value is 1,25,000, and debt value is 1,25,000 again. So we have three types where we can calculate cost of capital. One way is to calculate it manually, like 4% plus 10% minus 4% into 1.25%, sorry, 1.25 into 1,25,000 divided by this will be added, which is 2,50,000 plus 14% into 1 minus 30% into, like this we cannot calculate cost of capital. It will be very hectic for us. Second way of calculating cost of capital is to calculate it through by selling, like we have done selling over here, like risk free rate minus ERP into beta is equals to cost of equity, then cost of equity into weight, which is into equity to the rupee capital. Like that we can do selling. Apart from that, we can do one thing also, we can use name manager. So name manager will be coming under formulas, and under formulas we will be getting create from selection. So first we have to select the data over here and select this thing, and once you click on OK, and then you will be having this like equals to risk free rate. So here you will be getting this like function we usually get in our Excel, like sum, if, error, like that we will be getting, and it will be taking the data from this table only. So like this name manager will be used, and also this will be not used by professionals also. Another form which will be used is different. So again, what I will be doing, I will be calculating individually. Like for calculating ERP, what I have done, I have given name manager function over here, and I have calculated my ERP. Then with beta I have calculated my cost of equity. Then with cost of debt and tax rate I have calculated post tax of tax cost of debt. Then with equity value and debt value I have calculated my equity funding and debt funding. Now one thing manually do calculations, and second thing is selling. Third thing I have told you all that use name manager. Apart from that, what professionals use is, if we want to calculate cost of capital, they have given selection for their cost of equity and post tax cost of debt and equity funding, debt funding, and this four will be giving us the calculation of cost of capital. So this is the simplification second rule. Third rule is if I want to calculate my debt to equity ratio and my coupon rate I have to calculate. So for that I will be using if function, but not only if function I will be using nested if. Nested if is, if we are using if function and inside that also we are using if function multiple times, then it will be considered as nested if. So we will be taking it as, if 25% is our debt equity ratio, then use 30%, or else use coupon rate as 9.50. Like that only I have taken 2 times if function, and then when I entered it, so for my 25% it is showing me coupon rate of 9.50%. So debt equity or coupon rate is actually debenture issuing rate, which coupon rate is our of our company if we want to find out. Next is our debt to equity ratio, and if we don't want to use nested if function, so we can use our VLOOKUP function. So with that we have to select the lookup value, which is 25%, table array, where we have to find out the coupon rate. So we have selected debt to equity ratio, risk rating and coupon rate table, and then where we will be finding our coupon rate is in third column and in first row. When we click on enter, it will be showing us the coupon rate as 9.50 function. In this we will be taking 1 because of approximate match. If we take 0 over here, which is exact match, so it will be showing us hashtag NA, which is not applicable. So it is recommended to use 1 for approximate match, and it will be showing 9.50%. Now coming to our advanced simplification, which is first is our goal C. So advanced simplification is likely moves into more detailed metrics like EBITDA, EBT, taxes, depreciation, etc. So once our cafe is running, we want to understand how operations, interest, taxes and equipment cost affect our profit. So these advanced terms help us to go beyond basic profit and see the real picture, how efficient our business truly is. So first is our goal seek, where it is used to find what input value is needed to achieve a specific goal. So let's take over here sales growth as 10%. Now I want profit of 19,570, and I want to know that how much sales growth I have to increase so that I achieve this profit. So for that, what I will be doing, I will be selecting data. Under data we will be getting what if analysis. In that I will be going to my goal seek function. Once I click my goal seek function, it is asking me set cell. So for setting cell of this, which is gross profit, to value 19,570, and by changing cell is 10%. So if I click on OK, it will be showing me I have to increase my sales as 124.94% to achieve this profit. So if I click on OK, then it will be showing me the table which was for goal seek function, but it cannot be changed. So like this we will be using our goal seek function. Next is our data table, where it used to show how different inputs affect an output. We have taken same data over here also, and now I have to calculate my gross profit for different sales growth. So I have taken 9570 as my gross profit over here, and I have formatted it as italic, and I have colored it in gray color so that it will be shown over here. And in sales growth I have made a table from 8%, as I want to calculate different sales growth on different percentage. So I have taken different I have taken 2% difference over here, like 8%, 10%, 12%, like that I have calculated. Now if I want to calculate my sales growth and gross profit, I have to select my data. Again, I will be taking from data what if analysis, and data table we have to select. It will be asking us row input cell. So in row I am having gross profit. No, we are having gross profit in our columns, and when I click on OK, it will be showing me 0.1, 0.2. It is not right. Now what we will be doing, we will be selecting our 9570. No, we will be selecting our sales growth and OK, and then it will be showing. Because gross profit is already with us, we have to understand sales growth. So in different sales growth, the gross profit is this much. So this is how we make data table. Now if I want to do scenario analysis, again the same thing we have to do. Now in different things we have to do. What I have done, I wrote sales growth over here and gross margin over here. Now my gross margin is increasing by 20% from 40 till 90, and 2% sales growth is there from 8% to 24. Now if I want to calculate, again I will be using the same function as data table, and row input cell, it is asking me row gross margin is there, and in column I am having sales growth. And once I click on OK, it will be showing me the table it is having. So this is how we take scenario analysis. So scenario analysis help us preparing for all the possibilities, like carrying an umbrella just in case. Then comes our scenario manager, where the same data is there. So a tool that stores and compares multiple scenarios. So it will be like the same. I have taken data over here as what if analysis and scenario manager. Now I have taken 3 types of scenarios: base case, worst case and best case. Okay, now if I want to edit one, so best case I have taken and I have selected these 3 cells. If I click on OK, it will be showing me what do you want for your best case. So I want to increase my sales as 15,500. My sales growth is 20% and gross margin is 70%. When I click on OK, it will be covering in best case. Then worst case, same like best case. What worst case are you expecting that it will happen? So my sales will be decreasing by 13,500. 7% will be my sales growth and 50% is my gross margin. Base case, what will be like that? Current sales is 14,500, 10% sales growth and gross margin is 60%, and OK. Once these all cases are made, you have to click on summary and it will ask you about the scenario summary, where you want to use it or where you want to see it. So first thing is scenario summary, or in the form of scenario summary or scenario pivot table report. So I want scenario summary. If I click on OK, it will be showing me this in different sheet. It will be showing me the current value, base case and worst case and best case with different values, and it will be showing me if I am having current value of 14,500, base case and worst case and best case. Like that, it will be creating scenario summary for us. So scenario summary is it summarizes the outcomes of all scenarios side by side. So this is what our scenario summary is. Now coming to our data validation, which means it controls what inputs a user can enter. So if this is my data over here, if I increase my sales growth by 100 or 110, it will be showing me this error like, please note gross margin is profit left after the cost of sales should be less than 100%. So again I am giving 10% over here, and if I increase 10% over here, it will be showing me a small dialog box where it is giving me warning that you have input incorrect gross margin, it should be less than 100%, please recheck. It is asking me continuing, so if I click on yes, so it will be changing my whole data. Now if I want to see what invalid data is and where it is, so I will be clicking on data validation and clicking on circle invalid data. So it will be showing me this data is invalid, so I have to correct it again by 100%. so now it will be same as before. Now coming to our next, which is protecting cell sheet, where we will be using this particular function to lock cells or sheets from editing. Now we have created a perfect model and we don't want our calculations to get messed up, so protection is like putting a lid on your secret sauce, no one can spoil it. So for that, what we will be doing, we will be going to our review section. Under that we will be getting a protect workbook option. Then if we click on this protect workbook, it will be asking us password, and if we click on OK, it will be protecting, or it will be giving security to our sheet. Now if I want to enter or if I want to add any more sheets, I can't do that, and now my sheet is fully secured, no one can add more sheets in my workbook. So today we took the first step into the world of financial modeling, not through complex formulas but by understanding how numbers tell the story of a real life business, whether it's a cafe, a startup, or even your personal budget. So the same principle applies: track what you earn, manage what you spend, and use smart tools to plan your future. So financial modeling isn't just for analysts or accountants, it's for anyone who wants to make better decisions using data. So next time you think about profit, cost, or investment, remember you have the power to model it, visualize it, and improve it. So thank you for joining today's session. Keep practicing, stay curious, and don't just learn the tools, use them to tell meaningful financial stories. See you in the next session.